With the rise of EV manufacturers, we are never short of new releases of vehicles. A couple hundreds of EV manufacturing companies are currently vying for the attention of the market. With this many players, is NIO really still a good company to invest in? In China alone, the competition is really fierce. An estimate of around 200 companies are now in the EV manufacturing industry. Add to this the huge number of part suppliers and other companies that produce raw materials for the EV manufacturers. Saying that the market is tough is an understatement. However, NIO's position in the market is strong. In today's video, we'll discuss the strengths of NIO and how they differ from the competition. Then, we'll look at the price predictions of NIO to help you have a fuller understanding about the future of the company. There's a whole lot of information to unpack here, so let's get started. Disclaimer: NIO has gained significant attention as one of the most exciting electric vehicle companies globally and ranks among the top 10 largest EV makers worldwide, being the third largest in China. The company made a splashy debut on the New York Stock Exchange on September 12, 2018, with an initial share price of $6.26. In just 3 years, NIO's stock soared to an all-time high of $62 in February 2021, before experiencing a dramatic decline to its current price of around $4 per share. This steep drop of nearly 93% followed a period in early 2020 when the stock surged primarily due to market momentum. As high as it grew during the surge of EV companies and the hype over the use of electric vehicles, it also dropped significantly and has stayed relatively low as of recently. I'm sure at least one of you here is already anxiously waiting for the stock price to go up, especially since the latest news and updates on NIO's advancement in their tech. However, despite the volatility in its stock price, NIO's brand in the EV market remains strong. The company is still viewed as a premium player in the industry, particularly for pioneering battery swap technology. This tech offers a solution to the common issue of range anxiety by providing an alternative to traditional charging methods. However, while NIO initially performed well, the company's journey has encountered challenges. It's now facing some difficulties in regaining a bullish momentum, struggling to overcome recent market conditions and competition. Despite these challenges, NIO continues to innovate and maintain its status as a significant player in the EV sector. One of the reasons why NIO retains a good standing in the market is because of the company's sheer size. As you may know, NIO is China's third largest EV manufacturer and is 10th largest in the world. This is not an easy feat to achieve given how cutthroat the industry is. NIO is one of China's rising stars among a group of emerging car companies. While it may not be as large as its competitor BYD, NIO benefits from being part of the world's largest EV market. In April, the company delivered over 15,000 vehicles, a significant increase of 137% compared to the previous year. Over the first 4 months of the year, deliveries reached 45,000 units, marking a 21% year-over-year growth. To boost future sales, NIO has ventured into the luxury market with the launch of its E7 model, which is designed specifically for premium executive users. In an unexpected move, NIO secured a partnership to obtain more EV batteries from BYD, China's largest EV manufacturer. Additionally, there are rumors about NIO launching a more affordable brand called Onvo, with the Onvo L60 model expected to compete directly with the Tesla Model Y. This strategic move would allow NIO to offer a wide range of vehicles, from high-end to more budget-friendly options. One of the reasons Chinese car stocks like NIO are becoming more appealing is the possibility that Western countries may reduce the high tariffs on these vehicles. If this happens, it could position Chinese EV makers as cost-effective competitors in the global market, especially as the demand for EVs picks up after a recent slowdown. NIO's growth in China has been impressive, and the company is well-positioned to expand its success beyond its home market. But should this be enough to make you decide to go and invest in NIO? Not quite, but here's more reasons why their stock's performance just might start getting better. NIO's stock price is being driven by 3 main factors. First, the company's product portfolio expansion and growing market share are crucial. Just like Tesla, NIO started with high-end models and is now using that success to fund more affordable, mass-market vehicles. They're not just focusing on lower price points, they're also expanding options for their premium customers. A key part of their strategy includes innovative services like their battery swap technology, with plans to introduce a battery-as-a-service model and establish over 4,000 swap stations globally by 2025. Second, NIO is increasing vehicle deliveries and market penetration. The market for new energy vehicles, NEVs, in China is growing. and NIO plans to double its vehicle deliveries by 2025 compared to 2023, reaching around 165,000 units. This will still only represent about 2% of the Chinese NEV market, suggesting significant potential for growth. NIO is also expanding internationally, with the first overseas battery swap station established in Hungary in 2022 and several service centers and accessory businesses across Europe. Lastly, advancements in technology and customer experience are pivotal for NIO. The company is focused on charging solutions to help address range anxiety and reduce overall vehicle costs by 15% to 30%. Additionally, NIO's leadership in EV technology resonates particularly well with younger consumers who prioritize advanced tech features. As the company expands its product offerings, increases its market presence, and continues to innovate in technology, these efforts are expected to boost its stock value over time. So, with all these, what are the predictions for NIO's future sales and ultimately the company's stock prices? Here are the potential numbers according to Wall Street analysts. Looking ahead to 2030, the forecast for NIO's stock suggests a positive trajectory. By 2025, NIO's revenue is projected to reach $13 billion, and by 2026, it should climb to $16 billion. The company is forecasted to see significant growth by 2027, with revenue reaching $19 billion and a price-to-sales (PS) estimate of 1.5 times. In 2028, revenues are expected to surge to $36 billion, maintaining the same PS ratio. The following year, a slight dip is anticipated, with revenue at $25 billion, but the PS ratio remains steady at 1.5 times. By 2030, NIO's revenue is projected to recover to $27 billion, with the PS ratio increasing to 2 times. The outlook for NIO's stock price over the next several years appears promising. Wall Street analysts forecast that by 2024, NIO's stock could reach $6.94, representing a potential upside of 57% from its current price of around $4. Among the 26 analysts covering the stock, the consensus recommendation leans towards an outperform rating with a score of 2.07. For 2025, Rivian is projected to see a significant revenue growth of 60%, with a price target of $6.63, offering an upside of 50%. The following year, in 2026, the expected price is $7.80, reflecting another strong revenue increase of over 50%. However, due to negative EBITDA, the stock might not see as high a valuation multiple, though it still projects a 77% upside. In 2027, Rivian's stock price is expected to jump to $13.80, driven by another year of over 50% revenue growth. This marks a significant 97% year-over-year gain, equating to a 213% increase from today's price. Looking further ahead to 2028, NIO's projected price-to-sales ratio is 1.5 times, with anticipated revenue around $36 billion. This suggests a potential stock price of over $26, an impressive gain of 499% from the current price. In 2029, NIO is expected to continue its revenue growth, with a projected stock price of $18, marking a 310% increase. By 2030, estimates suggest the stock could reach over $25 per share, a remarkable 487% increase from today's levels. These projections paint a promising picture for NIO's financial growth. The steady increase in revenue and a consistent rise in the PS ratio indicate strong investor confidence and the company's potential to continue expanding its market presence and profitability. Will you be investing in NIO with these predictions? Let us know in the comments below. If you want to learn more about NIO and the EV industry, you can also click on any of the videos on your screen. And lastly, it would greatly help the channel grow if you interact with the video. Leave a comment, like, and share this with your friends. See you in the next video.